Let's do the numbers. In a nutshell, in the first quarter, stocks moved up while bonds lost money. The landscape has altered materially. U.S. large companies moved up further by 6%, but small company stocks zoomed 13%. Even international stocks returned 3%. As interest rates became the new volatile kid on the block, bonds lost 4%. Oh, what a change we've seen in 3 months. COVID cases are way down in the U.S., vaccination rates are hopping, resuscitating leisure and hospitality. Airplane occupancy is now 90% of pre-pandemic levels, almost back. Yes, it's too much, too far, too soon. We are seeing a small backup in COVID cases, but the trend is clear for the U.S. Not so for Europe, where COVID continues to rage and bureaucracy retards vaccination progress. Our labor market continues to recover as the unemployment rate drops back to 6%, which would be higher if the labor force participation rate hadn't shrunk 2% to 61.5, a big deal. Women and unskilled workers remain at risk. Federal unemployment benefits extending to Labor Day will help those bridge the gap until they return to jobs. When translated to Wall Street, we've seen the 10-year U.S. Treasury note erratically bounce from 0.9 to 1.7% now over the quarter. That's a huge move and a sign some see inflation ahead. The Federal Reserve Board has cautioned that a one-time uptick in prices is to be expected, and then all will be calm on the inflation front. Most strategists agree, but a handful think differently. The Fed continues to purchase $120 billion of bonds monthly, adding liquidity and increasing money supply 30% over the last year to combat COVID's economic damage. Congress's $1.9 trillion March fiscal stimulus is hitting the consumer, increasing the savings rate beyond historical levels. That pent-up demand will be unleashed on the economy later this year, jump-starting corporate earnings according to pros. Various experts predict last quarter's corporate earnings will increase from 2020's first quarter COVID lockdown level by an amazing 20 to 30%. Next quarter's comparison should look equally robust. Stocks seldom take a rise in interest rates well, but the rumors of continued stimulus have muted any drawback. There has been much roiling beneath the waves as large company stocks, chiefly tech companies, stalled while small companies surged forth. Investors unfavored growth companies and plowed money into value companies. Your portfolios are diversified, investing in broad arrays in both stocks and in bonds to better weather these shifting winds. I have come to appreciate how atypical these times are and the few experts' views which diverge from the huge consensus we're seeing among pros. One aspect is certain. No one knows what to expect with much certainty because we are in unprecedented waters. Schwab Institutional employs 3 strategists, each of whom are pounding the table to diversify portfolios thoroughly and carefully. Asset prices have been pulled forward. You've seen it yourself around you in real estate prices. We hope the economy will grow ahead robustly, expanding corporate earnings sufficiently to gently moderate the market's high valuation level over time. We are individually and as a society in an Apollo re-entry phase. It's time to remain aware and to follow sound strategies.